inflation's tilting towards deflation, and the Fed's there'll be the major consensus out there. So, well, they can't ease with the ease they have in the past because of the inflation they created last time. So to me, that to me is the bearish scenario that markets are starting to price for. It's pricing for 50 basis points actually by December, we're pricing for 4.5%, and rates are going to go up above 5% in next week or 2 weeks. And to me, that's just not going to happen until markets force them to. It's the new world that people who've been buying dips in the stock market forever are not accustomed to yet, I don't think.
As a result of the recent failures of several banking giants, inherent risks in the financial system have been exposed, and massive layoffs have been recorded in the technology sector. The upcoming financial crisis, according to Bloomberg's senior commodities specialist Mike McGlone, could be the worst in our lifetime, on par with the Great Depression, which began in 1929. Indeed, McGlone outlined how the current state of international markets was remarkably similar to that which occurred just before the Great Depression of 1929 to 1939, and how it threatened to be even worse. According to Mike McGlone, the Fed will only make a policy change if the market demands it, and a sharper decline in the S&P 500 would be the most likely catalyst for a change in monetary policy.
I think the only thing that's going to stop them from raising, they're at 92% that they go 25 on the May 3rd meeting, is a pretty sharp correction in the stock market. I still think that's the main problem that people are not figuring out yet. Even the debt crisis might not get resolved until the stock market makes it get resolved. It's just how these things are right now. So I got to meet with Dave Alteg of the Atlanta Fed last week, and he, I think he was surprised that when I told him, do you realize that the producer price index, it's only been around 75 years, it's falling at the fastest pace in the history of that index? And he kind of like gave me a ham. Now, he was very good. I really thought he was nuanced in the meeting, but he did point out they thought they handled this banking crisis well. He didn't say it, but my implication I get from his because the stock market and the markets did okay with the response. So they didn't do much. It was the Treasury that did it. But the key things I'm pointing out right now is I have to warn our VIS listeners, need a little bit of a disclaimer, because my job is just to be a trader. I mean, I used to sit in those phones. I was a trader, and I'd spent my whole time trying to help people mitigate risk and make money. We didn't have a view about anything except to try to make money. And my view right now is I'm bearish almost everything. Bitcoin, Ethereum, stock market, except for long bonds and gold. And I have to say why, because same narrative. We bounced to really good levels. And the sense I'm getting in cryptos and doing all my research is the worst is over. And I look at that as a trader. When you've got money on, and you sense everybody thinks the worst is over, yet there's a significant fundamental reasons for the worst not to be over. I haven't even started the recession. The Fed's still tightening, and cryptos are still, they bounced. Then you want to structure positions accordingly. So I think this 30,000 level in Bitcoin, 22,000 level in Ethereum are pretty serious. And when I can say things like a fact that hedge fund positions, managed money net positions in bonds, 10s, and 5-year futures, this was my brethren. This is why I started the business. Shortest ever. Yes. And when you can say that, and there's only one case and example that was close, was 2018. That was right around bond yields. 10 years peaked around 3% and then dropped to next to zero. I look at that and was like, oh, in that environment, you want to be selling stock market, buying treasuries, buying whatever they're short. I'm glad you knew that. And buying things like gold. And you don't want to be long any risk assets. Now, yes, it could be wrong in the short term. Maybe it's just hedging. But this is an example of how I think technology has changed. I remember in the mornings, when in the trading pits, first thing you'd go in the morning is you get the sheets. And you check out what positions were and what open interest did and stuff. Now it's all electronic, instantly. Now this data is once a week, but to me, it's just how it's migrating so fast. I see that kind of data, and I see what happened recently at crude oil. It bounced for a good reason. OPEC, it just squeezed the shorts, going back to bear market. Copper, going back to bear market. And the sense I'm getting is most people are saying, oh, I'll bet a dip. I'm like, these are significant bear markets in commodities. You're supposed to sell rallies. And everything is teetering to me on the stock market. And cryptos might be pointing out you're supposed to be doing that short term. Now, yes, you've heard this narrative from me before. It takes a while. I remember 2007, it was a really tough year for me. I was trading them. But this is how I see everything at the moment now. And just the key thing I want to mention leaving you with is this. I think we're on the cusp of a significant deflationary cliff, and the only thing that's holding it up is the stock market. It has to stay higher, or things like crude oil is going to just drop to 40. I don't see what stops it other than things I can't predict, like wars. I think the March bank issues are very much trees in the macro forest. And what was the main reason this happened? Because rates went up so fast and people didn't hedge properly. And the key point is rates are still going up. Yes, they're fixing each tree, but the forest is burning. And I think that's the macro is overwhelming. The fact that the Federal Reserve is still tightening. Yes, they might stop soon, and the rules of long and variable lags are just getting started. And then there's also going to always be opportunities, markets that lag that. So to me, some of that stuff is watch the money that's leaving banks. It's just cannot expect a credit contraction without that. You kind of not expect a pretty significant pressure on the economy when you see that, and particularly the Fed tightening. And the key thing is the foundation for all this is where were risk assets before all this started? Remember, the stock market was one of the most expensive ever in many other measures. So I look at what's happening now as part of that slow moving trend. I see significant deflation in commodities, significant deflation in PPI, all the leading indicators, and the Fed still tightening. And the bank contractions is part of it. Now you look at things, okay, where's that going to matter? Let's look at housing. New homes under construction, peaking from the highest level ever. Data is only 50 years on that one. Home sales, mortgage applications. I mean, this is clearly deflationary trends. And you look at the key thing that my colleague Anna Wong pointed out this morning was ECI and personal consumption expenditures will remain sticky. Those are the main inflation measures the Fed looks at, but that's the problem. They're still focusing on those things. So I look at it that this is things that I pointed out in 2007, and it's worse. Because back then, you actually had a stock market that wasn't as lofty compared to 10 years ago. The market still believes that the stock market trend is up. I think that's due for decoupling. The Fed stated it. Chairman David Attic said, he said, we expect unemployment to go up and inflation go down. Now, it's virtually impossible to have unemployment trial from this level without a recession. It's just the way history's always worked. When you have the lowest unemployment in 60 years, it always happened a few times. And then it's that sensation I think people are forgetting. And of course, he fully says we're on track for a soft landing. Priced in. Boom, great. Everybody's priced in a soft landing. Where's your optionality? That we don't get a soft landing, that we get a normal reciprocal cycle from the biggest pump in liquidity that's dumping ever. Now, Bitcoin was such a big part of that. Cryptos were such a big part. And we both agreed 22,000, 23,000 cryptos is ridiculous. A lot of those have to just get purged. Ethereum probably do okay. Bitcoin should be the best one. But here's a fact. On a one-year basis, gold's up about 5%. Stock market's down about 5%. Bitcoin's down about 30%. Commodities down about 30%, 20%. That's a trend. And I think that's going to continue. But here's the key inflection point. Once we wake up one morning, it's going to happen. You see, if I'm wrong, but at some point we have to see the stock market breaks. We have to see how Bitcoin responds to it. And I think the key thing that might be happening is Bitcoin can lead that. Cryptos can lead that because they're the most speculative assets in the world. And they play a trade on weekends. A lot of times they just lead. Then some point break down. So it was nice to see that the bank indices break down and Bitcoin break up. But now we're at that stage. I just get this every place I go, like NFT, Miami NFTs. Oh, it's an NFT winter. And you go to Bitcoin cryptos. Oh, it's a crypto winter. I'm like, no, it's an everything winter that's bounced. This is what the key thing I need to point out to people who only trade Bitcoin, and then there's people who never trade Bitcoin and trade equities. Is everything has been together with the Fed, and that's the key thing. The Fed is still fighting the Fed if you're too bullish here.
Although the SEC did not provide a public response to Coinbase's petition, it has recently increased its enforcement actions and warnings against cryptocurrency exchanges like Coinbase. We have yet to see how this plays out, but it is clear that crypto enthusiasts are rising to the challenge and aggressively pushing back against the SEC. Is Mike McGlone's macroeconomic forecast for the financial market something you agree with? Please share your thoughts in the space provided below. Thank you for tuning in to Market Empire. We hope you found this interview with Mike McGlone informative and thought-provoking. Be sure to subscribe to our channel to stay up to date on the latest news and analysis from the world of finance and investing. Until next time, happy trading.